Hey everyone, welcome back to the channel. Before we dive into today's essential topic, make sure you hit that subscribe button and ring the notification bell. Today, we're exploring something that affects almost everyone, but few people truly understand. How do banks actually work? You probably use a bank for checking, savings, maybe a credit card, a loan, but do you really know what's happening behind the scenes? How do banks make money, and what do they do with your deposits? Drop a comment below with your biggest question about banks. Now let's unlock the mysteries of the banking system. What banks do and why they exist. At its most basic level, a bank is a financial intermediary. It stands between people who have money and people who need money. This intermediary function is crucial to modern economies. Banks perform three core functions: accepting deposits from customers, making loans to individuals and businesses, and providing payment services through checks, cards, and electronic transfers. Why do we need banks? They solve several critical problems. First, matching savers and borrowers would be nearly impossible without intermediaries. Imagine finding someone who wants to borrow exactly what you want to lend for exactly the right time period. Second, banks have expertise in evaluating creditworthiness that individual savers lack. They assess income, assets, debts, and payment history to determine if borrowers will repay. Third, banks diversify risk by making thousands of loans. If you lend all your money to one person who defaults, you lose everything. Banks spread money across many borrowers, so a few defaults won't destroy them. Fourth, there's maturity transformation. Savers want quick access to money while borrowers need it for years. Banks pool deposits from many savers, so while individuals withdraw money, not everyone does simultaneously. Banks provide liquidity to the economy. Your bank deposit is highly liquid, accessible instantly, but loans banks make are illiquid. Banks transform illiquid assets into liquid liabilities, making the economy function smoothly. They also create money through lending. When banks make loans, they create deposits that didn't exist before, expanding the money supply. Banking evolved significantly throughout history. Early banks in medieval Italy were literally benches where money changers operated. The first modern banks emerged in Renaissance Italy. The Bank of Amsterdam in 1609 pioneered many standard practices today. Banking has fundamentally shaped economic development. Countries with well-developed banking systems grow faster because businesses can access capital. However, banks introduce risks. Because they're highly leveraged, they're vulnerable to runs where depositors try to withdraw simultaneously. Bank failures can trigger crises affecting entire economies. This is why banking is heavily regulated and why governments guarantee deposits through institutions like the FDIC. How banks make money, the business model. The banking business model centers on the interest rate spread. Banks pay depositors a certain interest rate and charge borrowers higher rates. The difference is the spread, where banks make most money. If a bank pays 1% on savings and charges 5% on mortgages, the 4% spread is gross profit, though costs must be covered. Different loans have different rates based on risk. Credit cards have the highest rates, often 15 to 25% because they're unsecured. Personal loans run 6 to 12%. Auto loans are lower at 3 to 8% with the car as collateral. Mortgages have the lowest rates, 3 to 7% secured by real estate. On deposits, checking accounts pay little because they're costly to maintain. Savings accounts pay modest interest. CDs pay more because money is committed for fixed periods. Beyond interest spread, banks generate substantial fee revenue: maintenance fees, overdraft fees, ATM fees, wire transfer fees. For some banks, fees represent 25 to 40% of total revenue. Credit cards are particularly profitable through interest on balances and interchange fees of 1 to 3% on every purchase paid by merchants. Wealth management and investment services are another major revenue source. Banks charge for managing investments, financial advice, executing trades, and managing trusts. These services are very profitable, requiring less capital than lending. Banks also make money trading stocks, bonds, currencies, and derivatives for their own accounts and clients. However, banks have substantial costs: employee salaries, branches, technology, cybersecurity, regulatory compliance, and most importantly, loan losses when borrowers default. They must also maintain capital reserves as required by regulators. Interest rate environments dramatically affect profitability. When interest rates rise, banks expand margins because loan rates increase faster than deposit rates. Understanding how banks make money explains their behavior, why they aggressively market credit cards, push certain accounts, charge various fees, and are selective about lending. Banks are businesses seeking profit, and their operations are designed to maximize revenue while managing risk.
When you apply for a loan, banks begin underwriting, comprehensive evaluation to determine if lending to you is good risk. Underwriters predict whether you'll repay the loan as agreed. Credit scores are typically examined first. In the U.S., FICO scores range from 300 to 850 based on payment history, 35%, amounts owed, 30%, credit history length, 15%, new credit, 10%, and credit mix, 10%. Your credit score dramatically affects approval and interest rates. Someone with a 760 score might get a 3.5% mortgage, while someone with 640 pays 5% or gets denied. Over 30 years, this difference costs tens of thousands. Beyond the score, banks examine your credit report for bankruptcies, foreclosures, collections, or late payment patterns. Income verification is crucial. Banks ensure you earn enough to make payments comfortably. They require pay stubs, tax returns, and employment verification. They calculate debt-to-income ratio, DTI, monthly debt payments divided by gross monthly income. Most lenders prefer DTI below 36%, though some allow 43% for mortgages. For secured loans, collateral matters. Banks appraise houses or value cars to ensure they're worth enough to cover the loan if you default. Loan-to-value ratio, LTV, is significant. If you're buying a $300,000 house with $60,000 down, your LTV is 80%. Lower LTV means less risk, often securing better rates. Employment history and stability matter. Banks prefer steady employment in the same field. Self-employed individuals face extra scrutiny with less predictable income. Banks also consider assets and savings beyond what you're borrowing, showing you could continue payments if you lose income temporarily. Risk-based pricing is fundamental. Rather than simply approving or denying, banks offer different terms based on risk. Lower-risk borrowers get lower rates, while higher-risk borrowers pay more. Automated systems now handle many decisions, especially for standardized products. Complex loans still involve human underwriters. Understanding the lending process empowers you. You can improve approval chances and secure better rates by building good credit, maintaining stable employment, managing debt-to-income ratio, and saving for larger down payments.
Banking is heavily regulated because bank failures can trigger economic catastrophes. Capital requirements are foundational. Banks must maintain capital, shareholder money, equal to a percentage of assets. If a bank has $100 billion in assets, it might need $8 to $10 billion in capital. This buffer absorbs losses before affecting depositors. Capital requirements are complex. Different assets carry different risk levels, requiring varying capital. Government bonds need minimal backing. Mortgage loans require more. Risky corporate loans need even more. This system, developed through Basel Accords, makes banks hold capital proportional to risk. Deposit insurance prevents bank runs. In the U.S., the FDIC insures deposits up to $250,000 per depositor per bank. Even if your bank fails, insured deposits are protected. Similar systems exist worldwide. This insurance prevents panics where everyone withdraws simultaneously. Since the FDIC's 1933 creation, no depositor has lost insured funds. Regular examinations ensure banks follow regulations and manage risk appropriately. Examiners review loan portfolios, check capital levels, and assess risk management. Stress tests, important after 2008, require large banks to demonstrate they could survive severe economic scenarios. Banks failing tests must raise capital or restrict dividends. Anti-money laundering and know your customer regulations require banks to verify identities and monitor suspicious activity. Banks must report large transactions and possible illegal activity. Consumer protection regulations govern bank-customer interactions, requiring clear loan term disclosure and prohibiting discrimination. The Dodd-Frank Act, passed after 2008, represents the most comprehensive banking reform since the Depression. It created the Consumer Financial Bureau, implemented the Volcker Rule, restricting speculative investments, mandated higher capital requirements, and created resolution procedures for failing large banks. Too big to fail remains contentious. When banks grow so large their failure would devastate the economy, governments feel compelled to rescue them. This creates moral hazard. Banks take excessive risks knowing they'll be saved. Regulators address this through higher capital requirements for systemically important banks. Understanding regulation helps assess bank safety. Insured deposits are extremely safe. Recognizing stress test importance helps you understand why regulators require banks to hold more capital even when performance looks strong.
Banking has undergone a technological revolution, fundamentally changing operations and customer interactions. Online banking began in the 1990s, allowing customers to check balances and transfer money via websites. Today, many people rarely visit branches, conducting all banking digitally. Mobile banking has become dominant. Smartphone apps let you deposit checks by photo, transfer money instantly, pay bills, apply for loans, and manage investments. Banks have invested billions in apps because customers expect seamless mobile experiences. Young customers especially expect banking to work like other apps, intuitive, instant, and 24/7. Payment technology has evolved dramatically. Contactless payments using cards or smartphones are standard. Peer-to-peer apps like Venmo, Zelle, and Cash App allow instant transfers. Digital-only banks like Chime and Revolut offer banking entirely through apps with no branches. They typically offer higher deposit rates and lower fees due to lower overhead costs. Artificial intelligence and machine learning transform banking operations. AI systems detect fraud, assess credit risk, personalize offers, and automate customer service. Chatbots handle inquiries, while algorithms make instant lending decisions. Machine learning predicts defaults, customer preferences, and optimizes operations. Blockchain technology and cryptocurrencies present opportunities and threats. Blockchain enables secure, transparent record-keeping without centralized control, potentially revolutionizing payments. Cryptocurrencies challenge banks' role as payment intermediaries. Banks are taking the threat seriously, with many offering cryptocurrency trading services. Cybersecurity has become critical. As banking moves online, it becomes a target for criminals. Banks invest heavily in encryption, multi-factor authentication, biometric verification, and fraud detection. Despite efforts, cybercrime costs billions annually and threatens customer trust. The COVID-19 pandemic accelerated digital banking adoption by years. With branches closed, people were forced to adopt digital banking. Many discovered they preferred the convenience and continued using digital services after branches reopened. Financial inclusion is both improved and challenged by digital banking. Digital services can reach remote areas without branches, potentially bringing millions into formal finance. However, the digital divide means those without smartphones or internet may be excluded from increasingly digital-only systems. Banking history is punctuated by crises causing enormous damage. Bank runs are the classic crisis. Because banks operate on fractional reserves, they can't return all deposits simultaneously. If depositors lose confidence and rush to withdraw, even healthy banks fail. The Great Depression demonstrated catastrophic consequences. From 1930 to 1933, approximately 9,000 U.S. banks failed, wiping out savings and contracting the money supply by over 30%. This deepened the Depression, leading to major reforms, including deposit insurance and stronger regulation. The 2008 financial crisis was the most severe since the Depression. It originated in subprime mortgages but spread globally. Major banks failed or required bailouts. Credit markets froze, threatening collapse. The crisis revealed that complex financial instruments had spread risks throughout the system in ways not fully understood. Lessons from 2008 reshaped banking. Capital requirements increased substantially. Stress testing became mandatory. The Dodd-Frank Act reformed regulation comprehensively. Banks scaled back risky trading and improved risk management. However, debates continue about whether reforms went far enough. Interconnectedness amplifies crises. Modern banks are linked through lending, derivatives, and shared exposures. When one large institution fails, cascading failures can follow. This network effect means problems spread with frightening speed. Leverage is a fundamental source of fragility. Banks operate with far more deposits than capital. A typical large bank might have $100 billion in assets, but only $8 to $10 billion in capital. This means just 5 to 10% asset value loss can wipe out capital entirely. The future of banking involves continued evolution. Digital transformation will accelerate with traditional branch banking declining. Competition from tech companies and fintech will intensify. AI and data analytics will become increasingly central. Central bank digital currencies may fundamentally change how banking works. Sustainability is becoming more important. Banks face pressure to consider environmental, social, and governance factors in lending decisions. Climate change poses financial risks through potential defaults, declining asset values, and regulatory changes. Cryptocurrency and decentralized finance could disrupt traditional banking, though the extent remains uncertain. If blockchain-based systems provide services more efficiently, banks must adapt. However, issues around volatility, regulation, and security currently limit mainstream adoption. Regulatory evolution continues as regulators try to keep pace with innovation, balancing fostering innovation with maintaining stability. International coordination becomes increasingly important as finance globalizes. We've explored how banks work from multiple angles: their fundamental functions as intermediaries, their business model and profits, their lending processes, extensive regulations protecting the system, technological transformation, and crisis history teaching painful lessons about banking's fragility and importance. Banks are far more than places storing money. They're complex businesses that create money through lending, facilitate payments keeping the economy running, transform short-term deposits into long-term investments, and take risks requiring careful management to avoid catastrophic failures. They're essential to modern economies, yet also potential instability sources. Understanding how banks work empowers you as a consumer. You can make better decisions about where to bank, what accounts to open, how to build credit qualifying you for good loan rates, and how to protect your financial interests. You can also better understand economic news about interest rates, bank failures, or regulatory changes. The banking system constantly evolves, driven by technology, regulation, competition, and lessons from crises. Tomorrow's banks will likely look quite different from today's institutions. Digital services will expand. Competition from non-traditional players will intensify. AI and data analytics will become increasingly central. Central bank digital currencies may fundamentally change how banking works. What surprised you most about how banks really work? Do you think banks are too powerful or necessary for a functioning economy? Are you concerned about banking becoming too digital? What do you think banks will look like in 20 years? Share your thoughts in the comments below. If you found this valuable, please give this video a thumbs up and share it with anyone who wants to understand this crucial part of our economy. Make sure you're subscribed with notifications on so you never miss our explorations of finance and economics. Thank you so much for watching, and I'll see you in the next video.